Pamela, in the last video, spoke about um, we spoke about adjustment one up to, I think it was up to adjustment 7, and we were supposed it was up to adjustment 6. So we are done with the slide here. We are supposed to, however, start with adjustment 7. And adjustment 7 says that we need to adjust the provision for bad debts to 5% of the outstanding trade debtors. Outstanding trade debtors. This is the debtors control amount that is still owed to us after taking into account the previous 6 adjustments. And whatever we are going to get as the debtors control amount, we will take that and multiply it by 5%. That information, I can only get it in trade and other receivables. So I will go straight to my trade and other receivables, and I'll come back to this. So we had done everything. So I'm going to close it. Okay, from that, after subtracting the 10,800, I'm going to close my trade and other receivables, which is trade debtors to be specific. I'm going to close that and determine my final debtors control amount. And my final debtors control amount here will be 172,200. Take that amount and multiply it by 5%. It'll give you provision for bad debts that must be recorded in this specific note. So take 172,000, multiply it by 5%. How much are you getting? You will get 8,610. That 8,610 is the final provision. And the final provision that you calculate, or the final provision that is given to you in the adjustments, is the one that you are going to record right here in your trade and other receivables note as provision for bad debts. And then you will subtract that from your trade debtors to determine your net trade debtors. And your net trade debtors will be 172,200 minus 8,610. And that'll give your net trade debtors amount of 163,590. And I will just leave it there. Obviously, there's nothing else here. So that 163,500, I will add it with the 12,370 to get my final trade and other receivables amount. This final trade and other receivables amount, I am going to record it in my statement of financial position, but I'll come back to that. Okay. I just want to deal with this provision and all the adjustments. Okay. Now, what I'm going to do now is to show you a brief calculation. Okay, I know that some of you will actually do this calculation. I wouldn't do this calculation because already I've done it in my trade and other receivables. The aim is to make sure that I earn as many marks as possible. But here's the thing. This provision that we've just calculated, you are going to compare it to the provision for bad debts that is given to you under the financial position in your pre-adjustment trial balance, and that will be the 9,000 rand. You're going to compare it to that 9,000 rand, which is the provision for bad debts. And when you compare the two, I don't know why they said it's on the 1st of July 2021, but it's fine. When you compare the two, this is what has already been recorded, the 9,000 rand. Remember, provision for bad debts is bad. It's bad because it reduces the value of your asset, which is trade debtors. It is an estimate of bad debts, of debts that will go bad in the future. Okay? It is an estimate of debts that will go bad in the future. Now, that estimate, we will compare it to what is being calculated. And when we compare it to what is being calculated, you will notice the one that we calculated is lower than the one that is in the pre-adjustment trial balance. And when that is the case, it means that the difference will be income. Okay, so why is it income? It is because the one that is already recorded, we need to take it down. When we bring it down, it becomes an income because it reduces expected bad debts. Okay, so the difference, we are going to recognize it as income, and we are going to record that under other operating income in the statement of profit or loss. When you go to your statement of profit or loss and the other operating income, you will record that as provision for bad debts adjustment. Please do not forget the surname, provision for bad debts adjustment. Just before we get there, I will quickly total off my sales. And when I total off my sales, I'll have 5,187,300. Then you minus your cost of sales, so close brackets, cost of sales, put them in brackets. So you will have 3,512,000. 5,187,300 minus 3,512,000. That will give you 1,675,300. Now that I'm done with that, I will record my provision for bad debts adjustment. Please don't forget to write the word adjustment, because when you write it as provision for bad debts, that is -1. It's a foreign item. Provision for bad debts is recorded in trade and other receivables. Here you record the income or the expense. If it's income, you record it under other operating income as provision for bad debts adjustment. Even if it's an expense, you will record it under other operating expenses as provision for bad debts adjustment. Don't forget the saying adjustment, because we know when you put the word adjustment at the end, it's either it's income or it's an expense. When you don't put it, we look at it as though it's a reduction of your trade debtors, which is what? Which is a valuation allowance, which reduces your debtors control. It increases on the credit side. Okay, and here it's different. If it's income, it increases on the credit side. If it's an expense, it will increase on the debit side. So provision for bad debts and provision for bad debts adjustment, they're totally different things. I need you to understand that. And we'll write this as 390. That's it. That is all. Adjustment 7, done. Now let's go to adjustment 8. The tenant has paid rent until the 31st of July. Rent was increased by 660 on the 1st of April 2022. Interesting. It was going to be easy because the fact that we received rent for July, or we paid rent, well, we received rent basically because the tenant paid for July. It means our rent is for 13 months. So you were going to go to your pre-adjustment trial balance, take whatever you have as rent income there and just divide it by 13. But you can't do it here. Why can't we do it? Because something happened during the year. There was an increase of rent by 660. That is a problem. So how do we deal with this? First things first, draw the financial year. And in your financial year, write down key dates. Write down key dates. My kids will normally write, because it will start on the 1st of July. They will normally write July, August, September, October, November, blah, 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 blah. I taught them that, okay. Especially when you look at your rent adjustment, go to podcast and check rent income adjustments there. You will notice that I stated all the months. I don't know if I stated all the months here. Oh, I did. I stated all the months. Guys, in your exam, there is no time to state all the months. There is just no time to state all the months. So this is our financial year. We know that started on the 1st of July, 2021. It'll end on the 30th of June, 2022. But we know from April something happened. I need to make sure that the increase was on the 1st of April or the 30th of April. It was on the 1st of April, which is good because that is key. Missing 1 month could be a problem. The fact that it increased on the 1st of April, it means that when I start counting the increase, it'll be from April until obviously July. Okay, but we're more interested in the current financial year. So July, we do not want it. We do not want July. We do not want July at all. Okay. And the reason why we do not want July is because it falls outside the financial year. Please never mind that 6,600. I'll just show you shortly what actually happened. So here's the thing, guys. From July 2021 to June 2022, that is a period of 12 months. But in that period of 12 months, from July to April, our rent was just X. We don't know what it was. So I'm going to take the number of months and times it by X because I don't know what my rent was. And let me count. It's July. 1, 2, 3, 4, 5, 6, 7, 8, 9. I can't count April because by April, rent has already increased. So I know that it was 9X. It was X for 9 months. That's what I know. And then after that, I'm going to add, after the increase, it was no longer X, but now it was X plus 660. Okay. But question is, it was this much for how long? It was that much for April, May, June, and July. So that will be 4 months. Okay. So when you add these two, they're supposed to give you your total rent, which is given in the trial balance. Let's see how much rent we have in the trial balance. The rent income in the trial balance is 88,440. It is 88,440. So all of that must be equal to 88,440. I'll go back here. It'll be equal to 88,440. Okay, this equation, I'm going to write it nicely in the next slide. And this is how I will write it in the next slide. Guys, from here, it's your grade 8 math. You distribute 4. You multiply x by 4. You multiply 4 by 660. You will get this. You're trying to solve for x. Add these two, which will be, when you add like terms, you just add the coefficients. 9 plus 4 will give you 13. And then you take this to the other side. When you take it to this other side, it'll become negative. Okay, so you'll end up having 13x is equals to 88,440 minus 2,640. That'll give you, and then I don't know how much that will give you. I jumped to that step. So I'll have 13x is equal to I'll take 88, 440 minus 2,640. It'll give me 85,800. It'll give me 85,800. Then you take 85,800 and divide it by 13. Then you will get that 6,600. But I need you to understand this 6,600 is the X. And when you look at the timeline, the X is that rent that we were receiving per month before the increase. So it was 6,600 before the increase. But how much is rent after the increase? It will be 7,260. How do I get that 7,260? You just increase that 6,600 by 660 for, obviously it'll give me 7,200. That 7,200 was the rent we received from May, June, and July. But there's a problem with the July rent. We do not want that July rent. We do not want that July rent. We do not want it. We do not want that July rent. Why is it that we don't want the July rent? It is because it falls in the next financial year. It falls outside the financial year. It is what we call a prepaid income, or in accounting, we refer to it as income received in advance or deferred income. We don't want it. And that income, we have to subtract it from our total rent income. And I will write explanation about that. We have to subtract it from our total rent income because it is not income in the current year. We owe it. We owe the tenant one of the two things. We owe the tenant a place to stay, or their money back if they don't want to stay there anymore. So that is why that part will be recorded in trade and other receivables. Okay. So basically I've just explained everything here. You would have seen what we did. So what we did is that, and I'll just recap on what I just done. So what I did was that I subtracted 7,260 from my rent income because my rent income will decrease by that 7,260. It was not earned. It was not, it is not supposed to have been received in the current financial year. So normally when I record that or I record it in my journal, I will debit my rent income as I've said, and I will credit income received in advance or deferred income. That is why I'm reducing my rent by that 7,260. But at the same time, as I have specified, that 7,260, I am going to record it in trade and other payables as income received in advance, so you can write it as deferred income. Okay, I'm just repeating this because I'm not sure if the sound was clear or audible. So that's what we need to do when it comes to rent. And let's go to the next adjustment. The next adjustment is basically about depreciation. We need to provide for depreciation as follows. On vehicles, it's at 15% on cost. And on equipment, it'll be at 10% per annum at the diminishing balance method. And they told you that a new equipment for 24,000 was bought on the 1st of March 2021. This has been properly recorded, which is good. So it means if they say that we debited equipment, we credited bank if it was bought for cash, or we created creditors control if it was bought on credit. So that was done. What that tells me though is that the cost price of equipment, which is given to us in the pre-adjustment trial balance. And I will highlight this because it's very key. It means the cost price of equipment, this 308,000, in it, we've got 24,000. But we can't depreciate these the same way because 24,000 was bought in the middle of the year, which is the 21st, well, which is September 2021. Forgot what the date was. So it was bought in the middle of the year. It will be depreciated differently because, first of all, it doesn't have accumulated depreciation, is new, meaning that the other equipment that we have heard for the whole financial year, from the beginning of the financial year, must be depreciated for 12 months. That one does have accumulated depreciation. Basically, when you take this 308,000 and you minus 24,000, you will get equipment, and whatever you get as the value of equipment, its depreciation will be this 170,500. Okay, if you don't understand that, I'll explain it shortly. Let us depreciate. And when I depreciate, I'll start with my financial year because that is key. And then I will start with my vehicles. The cost of vehicles at the beginning of the year was 520,000. Accumulated depreciation of vehicles at the beginning of the year was 156,000. And when I calculate carrying value at the beginning of the year, it will be 520,000 minus 156,000. It'll give me carrying value of 364,000. Someone might be wondering, but why are we calculating carrying value at the beginning of the year when this asset or vehicles are depreciated on cost price? Guys, check depreciation or tangible assets. I explained it thoroughly there. The reason why we're doing this is because we need to make sure that when you calculate current year depreciation, it does not exceed that carrying value at the beginning of the year. And how do we calculate current year depreciation? Because they told you vehicles, we depreciate them on cost price method, we will just take the cost price of 520,000 multiplied by 15%, and that'll give us 78,000. That 78,000, I will record it under operating expenses in my income statement. There it is. Operating expenses, I've got depreciation of 78,000. And that 78,000, I will also record it in my tangible assets note, which is note number 3, and I will record it as depreciation under vehicles. Okay, I just gave you depreciation on equipment. I'll come back to explain how we got that 13,350, but you'll put it under vehicles, it'll be 78,000. All right, let's move on. Now we're going to calculate depreciation on equipment. Financial year key. Now, this is a problem. I need you to determine the cost price of equipment at the beginning of the year. How do we determine it? Remember, cost of equipment at the moment will be 308,000 if I'm not mistaken. You will take this 308,000 and subtract 24,000. Why am I subtracting 24,000? Because 24,000 is the cost of equipment that was purchased during the year. It was not there at the beginning of the year. And right now I need the cost of equipment at the beginning of the year, which will be 284,000. And accumulated depreciation of this 284,000 worth of equipment will be 170,500. And then that'll give me carrying value at the beginning of the year, which is 113,500. This equipment, I've used it for the entire year. So when I depreciate it, because they said I depreciate equipment on diminishing balance method, carrying value method, or reducing balance method, you will take the carrying value of that equipment and times it by the depreciation rate, which is 10%. That will give you 11,350. This is just on equipment that we have heard from the beginning of the financial year. But that's not all. We purchased equipment on the 1st of September. So the equipment that we purchased, which is 24,000, we had it for September, October. Why am I taking September? Because we bought it on the 1st. If it was at the end of September, we are going to start counting from October. So we used it for September. We used it for October. And November, December, January, February, March, April, May, June. How many months will that be? It's 10 months. So that one we don't need to calculate carrying value because it is new. It doesn't have any accumulated depreciation. Remember, you are calculating depreciation now, which is the end of the financial year. So that's why I'm going to take 24,000 and just times it by 10%, times it by 10 over 12, which will give me 2,000. So my total depreciation just on equipment for the entire year will be the 11,350 plus the 2,000, and that will give me 13,350. Depreciation, how do we record it? You debit depreciation, which is an expense. When you debit an expense, it means your expense is increasing. So I will debit depreciation or increase my depreciation in the statement of profit or loss or the income statement by that 13,000. Already I recorded 78,000, which is the depreciation on vehicles. Now I'm going to add 13,350, which is depreciation on equipment. And in total, my depreciation will be 91,350. Done. Then I'm going to take that 13,350 and add it as my depreciation in note number 3, but it will be under equipment in this case. So I will add it under equipment as 13,350. Again, done. Easy, right? We're done with equipment and vehicles. Interesting. Okay, I think I must just deal with it at once. Now, guys, note this. The cost of equipment at the beginning of the year, I'll start with equipment, is 284,000. And accumulated depreciation of equipment at the beginning of the year was 170,500. So when you take 284,000 and minus 170,500, you will get 113,500. Under movements, did we buy any equipment? Yes, we did. How much was it? It was 24,000. You put it without brackets because it's a new edition. 24,000 minus 13,350, it'll give you a net movement which will be positive, and that will be 10,650. When you take 10,650 and you add it with 113,500, it should give you carrying value at the end of the year. But I'm going to do it step by step. When it comes to cost, you will take cost at the beginning of the year, which is this 284,000, and then you add any additions. And when you add the addition there, which is the 24,000, it'll give you cost at the end of the year, which will be 308,000. What about accumulated depreciation at the end of the year? Guys, I have tangible assets notes where I explain this thoroughly. So accumulated depreciation at the end of the year will be accumulated depreciation at the beginning of the year. Now, with accumulated depreciation, it'll be balance at the beginning of the year. It'll be increased by current year depreciation. I'll just say current year depreciation. So balance at the beginning of the year for accumulated depreciation is this 170,500. You will add it with current year depreciation of 13,350. And that will give us 183,850. Now take 308,000 and minus 183,850. It'll give you 124,150. Now, when it comes to vehicles, cost at the beginning of the year was 520,000. Accumulated depreciation at the beginning of the year was 156,000. Take 520 minus 156,000, you will get 364,000. Then to that, you will simply, well, there's no movement. We didn't buy any vehicle. We didn't sell any vehicle. So the only movement will be depreciation that you will put in brackets. And then to determine the cost at the end of the year is still the same. When it comes to accumulated depreciation, it'll be accumulated depreciation at the beginning of the year plus current year depreciation, which will give you 234,000. 520,000 minus 234,000, it'll give you 286,000. Then I'm going to go to my land and buildings. Land and buildings, nothing was said really, so it's pretty much the same. Guys, then you are going to add those three carrying values together. Then they will give you this total carrying value, which is 3,203,150. We will record that under tangible assets in your statement of financial position. So that will be your tangible fixed assets, non-current assets. And when we write it here, it'll be 3,203,150. Then under non-current asset, we've got tangible assets, we also have financial assets, but with your financial assets, we'll get back to it. I just need to record inventory, which was done already, which is in note number 4. The total will be recorded here, which is 484,660. If you're wondering why I got that, guys, I got it from my inventory note. It's this amount here. And then I'm also going to take this amount in trade and other receivables and record it there as well. Those are current assets. So it'll be inventory note number 4, trade and other receivables, which is note number 5. And that'll give us the total amount for trade and other receivables. Okay. And before I finish off trading other receivables, because we dealt with a fixed deposit earlier on, I just want to also record my fixed deposit, which was 310,000. So that 310,000 for fixed deposit, this 310,000, I'm going to record it under financial assets, under non-current assets. It'll be 310,000. You add your non-current assets with financial assets, it'll give you a total non-current assets. And this is the total for trade and other receivables. And I'll just leave it now there for now. I'll come back to this stuff as we go. Basically, guys, I'm done with number 9. Done with number 9. Let us go to number 10, where they say that we received a loan statement from ABC Bank. The balance at the beginning of the year is 560. The balance at the end of the year is 376. So in between, things happened. The first thing that happened is that we made a repayment, which is per month. So we need to take this and multiply it by 12 to get the total repayments. Just to make a cleaner calculation, I'll show this under workings. So the balance at the beginning of the year for the loan was 560,000. We made repayments which were 20,000 per month. Take that and times it by 12, it'll give you a repayment. We also have interest, but we don't know what it is, but we also have the balance at the end of the year. And the balance at the end of the year for this loan is 376,000. And the fact that you're doing this table, you need to know that, oh, I'm doing this table, it means my interest on loan is capitalized. So that 20,000, take it and times it by 12, it'll give you your total repayments for the year, which will be 240,000. Now, to get the missing amount, which is interest, you'll just use the reverse operation. You take this, you add that, you minus that. It'll give you your interest, which will be 56,000. This is interest on loan. That interest on loan, you are going to record it at the bottom of your income statement, right at the bottom, which is interest expense. Okay, so we'll record it right at the bottom, which will be your interest expense. So under interest expense, I will have that amount, which is my interest on loan. So my interest on loan here will be that 56,000 rand, and I'll just close it because it's the only one. Then I will put that as my interest expense. It goes right at the bottom of your income statement or statement of profit or loss. So I will have interest expense there, which is 56,000. When you record it, make sure you put it in brackets. That's it. I'm going to go back there to see if I missed anything. Oh, here's what I missed. They say 150 of the loan will be repaid during the next financial year. So what that tells me is that 150 is the current portion of the loan. So I will need to go to my loan amount. And at the moment, how much am I owing for this loan? For the loan, I am currently owing 320,000. But actually, I'll just go to my loan statement and show it to you from the loan statement. According to the loan statement, I am owing 276,000. Sorry for that. This is ABC Bank. I am owing 376,000. From that 376,000, I'm going to subtract this 150 because it's non-current. Now, what do I do with this 150,000? You will record it under trade and other payables as current portion of the loan because it changed from being non-current to being a current liability. And when I record this in my statement of financial position, I will go to my non-current liabilities where I have got, okay, I didn't start with my non-current liabilities. Where I've got 376,000 and I'll take that 376,000 minus 150. And the reason why I'm subtracting this 150 is because it's included under trade and other payables as the current portion of the loan. And the non-current portion will be 226,000. And I've explained this, guys. When we look at the loan, you are looking at it from the end of the financial year, which is the 30th of June 2022. You look into the next financial year, any part of the loan you're going to pay in the next financial year, it's current. So it's either you put it under current liabilities here, or you put it in trade and other payables, of which in this example, I calculated it or added it under trade and other payables. That's it. We're done with the loan. Correct. So I just meant 10, done and dusted. Let's move on. Adjustment 11. It says that the salary journal for June 2022 was completed. The accountant had, however, forgotten to complete the posting to the general ledger accounts, and the salary journal reflected the following. Gross salary is 15,000. You just stop right there. That 15,000 gross salary, you take it to salaries and wages because it's your expense. Salaries and wages, you'll find them under operating expenses. You will record that as salaries and wages. You add it because it was forgotten. You add it. You're done. Let's move on. Then we've got deductions. I really don't care about deductions because they're paid by the employee, but I'll talk about this. Okay. When you take that 15,000 and you minus your deductions, you will get a net salary. And this net salary here, we are going to record it in trade and other payables. These deductions were not yet paid by the business. So we deducted them from the employee salary, but we have not yet paid them. So all those deductions, we are going to record them in trade and other payables. I will start with my net salary. My net salary, I'm going to record it in trade and other payables as creditors for salaries. It'll be 9,900. Then I'm going to have my pension, which is what was contributed by the employee. It's a deduction. Then I will have, okay, I don't know why I added that. Then I will have my medical aid. I think they also had a deduction for medical aid. And that'll be 800 Rand. And then I'll just leave it there and just continue with normal business. And let me just read further. I'm done with all of these, basically. All of that, done. Okay. Then they say the employer contributes on a rent-to-rent basis to pension fund and medical aid. So you will notice that for pension fund, it means the employer also contributes 1,500 Rand. And for medical aid, it means that the employer also contributes 800 Rand. Okay. So basically, these are additional costs for the employer. And these additional costs to the employer, we are going to firstly add them under expenses as employer's contributions. All right, so basically, I will record them as employer's contributions, as I have said, and I will write the first as pension contribution and medical aid contribution. Note that sometimes I will tell you that it's added or debited to salaries and wages. It means that that 1,500 and 800, I was going to add them to salaries and wages. Sometimes it'll just show it separately as employer's contribution. So you were going to write employer's contribution, open brackets, add the 1,500 and then add the 800 Rand. Those two amounts, they add to what we already owe to the pension fund. So the pension fund is owed what was contributed by the employee and what we contributed. And that will give us our total amount that is owed to the pension fund and medical aid, which will be 3,000 and 1,600. Done. Now we're done with 11. Let's go to 12. 12 talks about the following details applicable to owner's equity. The owner contributed 635,000 cash to Very Tese Limited. This transaction was not recorded. Oh, and then they spoke about 30% tax and 97,600 was withdrawn from the business at the end of the year to pay school fees for his daughter. So the owner withdrew that. The bookkeeper did not record this transaction as it took place in the last day of the financial year. Okay. How do we record these ones? I will start with owner's equity. All right, let's see how we record that quickly. So we've got the owner that contributed 635,000 cash. This transaction was not recorded. So that will affect two accounts. We are going to debit bank and credit capital. Debit bank and credit capital. But before I can even try anything, I need to look at my balances. My bank balance is 250,920. And when you add all of these up, they will go to cash and cash equivalents. Okay. So I will quickly debit my bank by recording this in cash and cash equivalents, or basically just start with my owner's equity. Let me see what my balance for owner's equity was, which is my capital balance. Let's see how much my capital balance is. It is this 3,365,000. That's what I will start with. I'll also pay attention to that, but I'll come back to that one. So I'm going to start with that opening balance in my owner's equity, which is the balance at the beginning of the financial year. It will be 3,365,000. Note that my bank balance is 250,920. And I said you will add your petty cash there. You will also add your cash float to that. And I will quickly record those two. Cash flow was 0. Then I'm going to go to my income statement, because for me to complete owner's equity, I need net profit for the year. Okay, I will need net profit for the year, of which I will get in my income statement. And because I'm talking about owner's equity right now, it means that my income statement is pretty much complete. Okay, so when I complete it, I will start here. Find my bad debt recovered. It will stay the same. I'll just close it off and find my other operating income. So that 88,620, we just added this, guys. 420 plus 450 plus 81,180 plus 6,600 plus 390. It'll give me that 88,620. Now add that 88,000 with 1,675,300, and you will get 1,763,920, which is your operating profit. So when you add these two, they will give you your gross operating profit. For your operating expenses, let's see what you got for your operating expenses. I will just close off advertising, sundry expenses, and director's fees, as well as audit fees. Okay, just write them because there's no adjustment that relates to those. It'll give me my operating expenses. Always put them in brackets. So all of this added up. Okay, so you add all of these up. Plus 25,600 plus 365,000 plus 1,500 plus 800 plus 384,000 plus 40,500 plus 5,000 plus 91,350. It'll give me my operating expense. You put it in brackets. So all I'm going to do is to take my gross operating profit, this one here, and subtract my operating expenses, which is that one over there. That will give me my gross operating profit, which is the 38,910. Then you add your income. It'll give you your profit before interest expense. And once you get your profit before interest expense, it will be 663,710. You will minus those 56,000, which is your interest expense, and it'll give you your profit before tax. And for your profit before tax, please note that they told you that you're going to get taxed. Okay, obviously this is new to you. Some students haven't done this in grade 10, but obviously you will get taxed on your net profit. Even because you are an individual, when you open up a business, you will pay what we call pay as you earn. Obviously, you'll get taxed on your net income. You'll have to disclose the financial statement so that you can get taxed. So I will simply take my profits and multiply them by the tax amount to determine how much tax I need to pay. Please note that tax is an expense, okay? So my income tax here, you'll put it in brackets. It'll be 12,313. You minus that, you'll take 607,710 minus 182,313. It'll give you your net profit for the year, which is 425,397. That amount, I'm going to put it in my owner's equity as my net profit for the year, and that will be 425,397. You add your capital to it. And when you add your capital contribution, which was not recorded, by the way, so when I add the capital contribution, I will also increase my bank by the same amount because this was not recorded. And then you will subtract your drawings. Please note that your drawings here are increasing by 97,600. That is because 97,600 was what was taken by the owner. They told you the owner took money, withdrew. Okay, so took money from the business to pay for their son's school fees. So that will add to drawings, and drawings reduce owner's equity. You know this from grade 9. And obviously, we already had drawings from our pre-adjustment trial balance. Our drawings balance that was given in the pre-adjustment trial balance was that 202,400. It'll now increase by that 97,600, bringing up your drawings amount. So your drawings will go up to 300,000, and the whole 300,000 must be subtracted from your owner's equity. But I also need to specify that 97,600 was not recorded. So we need to reduce our bank account by that 97,600. So our bank account will be sitting at 688,320, and that will give us our total cash and cash equivalent. And we might as well get the balance for owner's equity, which is this balance at the beginning of the year plus profit plus capital contribution minus drawings. You will get balance at the end of the year. And the balance at the end of the year for owner's equity will be 4,125,397. Then we're done. So cash and cash equivalent will be recorded under current assets. So under current assets, I'm going to record cash and cash equivalents. It'll be 789,520. Then you can just balance this off. I would normally add this two to get my non-current assets, and that'll be 3,513,150, and then add these three to get my current assets, and that'll give me 1,450,120. Then you add these two ticks, which is your non-current assets. When you add them with your current assets, you will get your total assets, and that will be 4,963,270. Okay, so you add this plus this to get that. Okay, then you're done with this. Then we're going to go to equity plus liabilities. This is just your accounting equation. So owner's equity is what we got in our owner's equity, which was 4,125,397. I will quickly get my non-current liabilities and put them there. So I don't add anything there. It'll just be that 226. And I know some of you might be wondering, how did I get this 376? It is just the balance that was given to you for a loan of 320. And then you add interest because they told you that interest is capitalized. That's how I got it, okay? And I would get that balance, okay? And obviously, if you had a current portion of the loan, I was going to put it there, but here I didn't put it here as a current portion of the loan. I included it under trade and other payables. I explained that honestly. And what I'm going to do now is simply total everything up. I will start with my trade and other payables, which comes from note number 8. So for trade and other payables, let me see what I'm missing there in trade and other payables. I've pretty much recorded everything. I will start with my trade creditors there because there's nothing that had to do with trade creditors. I'll just put the total there, which is 325,000. And I will scrutinize my pre-adjustment trial balance for anything that I missed that I didn't record. I've recorded the mortgage, lending buildings, that is done. Trading stock is done, consumables is done, provision, debtors control is done, provision for bad debts is done, and all of those are also recorded. And I've got SARS income tax. Ooh, okay. And creditors control is done. Am I missing anything else? This side, I am not missing anything at all. Good. What about this side? Am I missing anything? I'm not missing anything at all. Good. I feel like I'm missing something. I just want to check something quickly here under my adjustments. Okay, I recorded everything, but why did I even highlight this? Because I do not remember recording that. So this is still owed to SARS. So because it is still owed to SARS, I will need to write it in trade and other payables as SARS pay as you earn. Okay, that's one thing that I missed out there, which is 2,800. The only SARS amount that I actually missed is the one in the pre-adjustment trial balance, but that one relates to income tax. Please note that when you have SARS income tax, obviously for most grade 10s and 11s, it won't be there. I just include this in my grade 10 so that my students can learn earlier on that we need to make provisional payments during the year. So when you have SARS income tax, which is 70,000 and it's on the debit side, these are provisional payments. Provisional payments are payments we make towards our tax expense, even though we don't know what our tax expense is. So here we made provisional payments amounting to 70,000. This is the payments we made to our tax expense. But from our statement of profit or loss, we calculated our tax expense as 182,313, but we've only paid 70,000. So we're still owing our tax expense. The difference is what we are owing. Because we are owing our tax expense, we will record that difference in trade and other payables, and that will be 112,313. And then you just add everything up. It will give you a total for trade and other payables. That total for trade and other payables, you will put it under current liabilities in your statement of financial position, which is that over there. And then we don't have any other liabilities. We don't have any bank overdrafts. Bank overdraft is when you have a negative bank balance. We don't have it. So our current liabilities will just be that 611,876. And for owner's equity, we are simply going to have that 4,125,397. I am going to take that and add it with non-current liabilities and add it with current liabilities, which is your accounting equation, by the way. And it'll give me my total equity and liabilities, which will be 4,963,270. And your total liabilities and equity must give you the same amount as your total assets, which completes your accounting equation, which specified that your assets will be equal to owner's equity plus your liabilities. So this is our total assets, which is current assets plus non-current assets, being equal to owner's equity plus liabilities. These are just your liabilities plus your liabilities. And once it balances, you know that everything is correct. That's it, guys. That's it. That's how easy it is. Okay. we know that everything is now correct. This is a full video based on your financial statements. We started with the income statement. Please check part 1 of this video, and we finish it off by completing the statement of financial position as at the 30th of June 2022, i.e. the balance sheet. That's it. Thank you for watching. Khotso.